Well, one stock that has pretty much made it this year for investors is Mazagon Shipbuilders. Just pull up that stock. It's at a fresh 52-week high today. It's up 3% just today, and it's had a dream run this year. So one-year chart would be helpful. Look at that. The rally started in the month of July, and now the stock is up almost 183%. It's had a good set of numbers as well. The revenues are up 8%. Margins came in higher at almost 7%. And the stock has been on a tear. Sanjeev Singhal, Director of Finance at Mazagon Shipbuilders, joins us now. Sanjeev, thanks a lot for joining in. You know, it's been a very strong year for you, especially with the ship repair orders that you bagged. But I just want to understand in terms of numbers, you're sitting on a base of almost 4,000 crores in the first half of the year. And there was a bit of a low base effect as well compared to, what happened last year with the pandemic, etc. Now, on a steady state, what kind of growth do you see for Mazagon Dock, and what would the triggers be?
Yeah, first of all, very good morning to everybody. As far as the growth is concerned, we logged in a figure of 5,753 crores revenue from operations last year. Going ahead, considering that the first half is already over, we would like to revise our guideline with respect to FY23 to around 25 to 30% of growth compared to previous year. So we are expecting somewhere around 7,400, 7,500 in case all the things go as per our plan. So that would be revenue guidance for the current year.
Right. Sanjeev, hi, good morning. 25 to 30,
good morning.
33% you said?
25 to 30%.
30%, okay. And this is better than the 19 to 20 which you have been maintaining till the last quarter, right?
Yeah, we are more confident of this now.
Okay, so you're upping your revenue guidance from 19 to 20 to 25 to 30%. I don't think you had given out a specific margin guidance. I mean, anything you can, since we are talking about guidance, anything you can tell us about that, margins?
Margins, we don't expect a significant change. However, there would be a positive effect definitely on account of raising the fixed costs as the volumes go up. So I would not be very particular about the margins. We would be maintaining a similar kind of a trend. Last year also the margins were better, and a slight improvement could be there based on the higher volumes.
Just to press on that point on the revenue guidance, when till the last quarter you were saying 19 to 20% every year for the next many years. Is typically how you describe. Yeah. Now you're saying 25 to 30. Will this be the steady state revenue growth, as you can see?
No, we would not be able to commit as far as FY24-25 is concerned. Yes, the revenue guidance would be somewhere around 20% as far as we see FY24 right now. But going ahead, we would be getting a better clarity on this.
So you'll be moving, Mr. Singhal, closer to around the 10,000 crore odd mark, going by the numbers that you're telling us. I wanted to ask you about ship repair. As a percentage of your revenue, how much is coming in from there? I understand that that's a margin accretive business, right? Your margins normally you have guided for around 7.5%. Do you want to stick to that, or is there a bit of a tailwind out there with operating leverage playing out, maybe a better mix as well?
Yeah, I would put it that way. As far as the yard is concerned, yes, we are looking for the opportunities in ship repair also. However, these remains a small segment of our business. And considering the capabilities and capacity of the yard and the skill set available, our main focus would continue on the execution of large value orders, particularly in the defense sector for destroyers and submarines. So that focus would definitely not be there towards repairs and exports, irrespective of the margin profile.
On that submarine portion, you had said that last time you'd said that there was a large order. P75I, if I have that correct. You said that the bid submission has been extended till the end of November. Has that happened, or is that true?
No, the bid submission date of project P75I is for India, P75 India. This is a set of 6 submarines, conventional submarines, fitted with the air-independent propulsion system and lithium-ion batteries, state-of-art. This is the latest, and the bid submission date was 30th November 2022. The same has not been extended. However, the tender also has not been closed. The issue was with respect to foreign collaborators. Certain 5 number of foreign collaborators were identified by the Indian Navy, and they were not responding positively. But the positive development is that 2 number of collaborators now have started responding positively, and this feedback is available with the Navy and also with MDL. So we are expecting these timelines to be slightly extended by the time the foreign collaborators respond and we are in a position to submit a bid in a consolidated manner.
So what would the extended timelines be?
This clarity would emerge, maybe it would take certain amount of time. Right now, this clarity is not there because subsequent to 30th of November, the timelines have not been extended yet.
So it won't be in this fiscal, is what you're saying? I mean, is that a likely possibility that it may not fructify?
The possibility is very much there.
Okay.
But we don't have the dates right now.
What, Mr. Sanjeev, so just a quick point. Are we to expect these kind of delays? I mean, how would you read this? Because I think you and L&T were there, right? And each of you is supposed to tie up with a foreign partner. You're saying there are two partners who are now showing interest. But is this a material delay? How would this impact?
Each one of us need to appreciate that we are talking of very large platforms, which are deeply complicated platforms, and to be executed over a number of years, 7 to 8 years. So number of agencies are involved apart from the Indian Navy, government, the foreign collaborator, the Indian executor, many suppliers, and the technologies. Everybody wants to be abreast with the technologies. So this is a complicated combination as such. So things do take time because at the end of the day, everybody wants the best of the platform with cutting-edge technologies. So there could be some delays here and there, but once the orders are finalized, it gives a very clear picture and the timelines are defined within which the platforms would be available for the Navy.
That is going to be the big trigger for the stock. So we'll have to wait by because it's a 40,000 crore plus order out there. But Mr. Singhal, could give us a sense on the submarine skill. Are they completely utilized? What is the current capacity utilization? I'm trying to understand that.
Can you get back again? What is the submarine
utilization, sir? Yes, I'm trying to understand what is your current capacity utilization. Are the submarine skill being utilized to its fullest?
No, as far as the MDL is concerned, we have a capacity of constructing 11 submarines simultaneously in a staggered manner at different stages of production. The order which we are executing right now is the Scorpion Submarines Project P75, which comprises of 6 submarines. 4 submarines have already been delivered. As far as 5th submarine is concerned, we are targeting delivery this year by December itself, and then we will be left with only 1 submarine. So as such, clear indication as far as the capacities for submarines, they are available and vacant right now.
So, the last time we spoke to you, you said that there could be significant capex from the company next year. But in FY23, you maintained your capex of 200 crores. Any change to that? I'm asking because you've raised your revenue guidance now. So will you be raising your capex as well?
As for FY23, we still maintain that a capex would not be exceeding 200 crores. It would be something around 150 to 200 crores. Yes, going ahead, we are looking to acquire one FDD, floating dry dock, in FY24. Once this order is placed, then FY24 be a bit higher.
Okay, very quickly, Mr. Singhal, I wanted to ask you, when the stock price does well, sometimes the government has that tendency to come and sell some shares. Have you heard of any, pulling down of stake and OFS in the offing? You're smiling. I think you've heard something.
Yeah, this is an area dealt with by DIPAM, Department of Investment Planning and Asset Management. So they would be better aware of this. We would not be in a position to comment anything on this.
All right, Sanjeev, great to have you with us here. It's a pleasure, and thanks very much that you could stop by and providing clarity. 200% is the year-to-date return on Mazgaon Dock. So it's just a complete astounding performance on the defense space. Now, Bajaj Consumer is the next company that we'll be going to be speaking with. The quarter was a weak one, and we have the management now joining us to take us through what the future holds. Jaideep Nandi is Managing Director at Bajaj Consumer Care. Jaideep, good to have you with us here. Good morning.
Hi, good morning.
So both gross margins and EBITDA margins have come in at pretty much historic lows for you. Could you give us some sense of how Q3 is panning out, and what are the factors at play?
So 2 things at this stage. So as you see, the markets, mainly for the discretionaries in FMCG, have been weak for quite some time now. Rural is under stress. So as a company, we have decided to, rather than just remain with almond drops, expand our portfolio. As far as that part is concerned, I think we are tracking pretty well. The company half year is at a value growth of around 11% and a volume growth about close to 10%, while the hair oils market as such, if you look at in the quarter, was down by 5.5%. In hair oils itself, our volume growth has been 6.4%, value growth of 7%. So that's what we are doing. If you look at our portfolio from a 4% new products portfolio that we had last year, we have gone up to about 12% this year. So that's what we are doing on one stage as far as top line is concerned. As far as the bottom line is concerned, you're absolutely right. The LLP is absolutely at its historic high. It is showing some signs of corrections. We have seen some price decrease as far as the LLP is concerned. So we feel that that would help ease pressure on the gross margin. But yes, we will still have to track that because both RMO and LLP compared to 2 years back as it are at much higher prices.
So this hair oil market, right? I mean, you spoke about how the industry was down about 5% and you did about 6.5%, 6.4% growth. Do you think there could be some more pressure in the second half of the year, particularly on for the industry?
Well, if you see the rural markets also is quite divided. If you look at the markets of UP, Madhya Pradesh, Bihar, Jharkhand, that part, the rural markets are a little more stressed than possibly the markets of Punjab, Haryana, Maharashtra. So we feel that slowly the recovery is showing some signs with the near monsoon. We are cautiously optimistic that will bounce back. On the other side, if you look at the alternate channels, modern trade, e-commerce have been growing phenomenally. For FMCG itself, as well as for us, we have grown exceedingly well. We had a 77% growth in modern trade, more than tripling our sales as far as e-commerce is concerned. Both of these businesses now contribute 9% each to our turnover, which was hardly about less than 1% 2 years back as far as e-commerce was concerned. So we feel that the urban is still doing well. We have been able to clock in a double-digit growth, even in general trade in urban. So urban is doing well. Rural is where we expect the recovery to come back.
Okay, all right. Mr. Nandi, good morning. You gave us a couple of numbers. New products, I think they've gone to 12%. What's the target out here? And if you could give us a timeline. And you're saying that RMO, that's refined mustard oil prices, have cooled off a little bit and a couple of other input costs have cooled off. So can we expect margin recovery from this 13.5%, 14% that we're seeing? If yes, by how many basis points?
So what we are planning to do, if you look at our advertising spends, we have significantly upped it. We are now at over 18% as far as our advertising spends is concerned, because what we have decided as an organization is beyond almond drops, we need to expand our portfolio, so de-risk ourselves, and that is tracking pretty well. So we launched 2 products, Cocoa Onion and Bajaj Cocoa Onion, as well as almond drop soaps, which is a part of a larger almond drop extension portfolio. Those are tracking well, as well as we have our Amla portfolio and coconut, which are also doing well. So our advertising spends will remain high, and we expect our EBITDA margins to, yes, correct a bit, but not significantly correct, because our investments will be a little there for the midterm, while we expect the corrections to happen for a 2-3 year period.
18% of sales on advertising, Jaideep. That's what you're saying, right?
Yes. So
okay.
advertising ratio to sales.
You know, you said that you began by saying you're expanding beyond almond drops, right? Is that basically lower products at lower price points? I mean, just tying that with the rural stress that you spoke about.
So it's a combination of both. So one is on the completion of our hair oils portfolio itself. So you have the almond drops portfolio. We have now the entire coconut portfolio, which is the pure coconut, as well as the Cocoa Onion, which is a value-added coconut. We have also the Amla portfolio that we have launched. On the other side, we have the almond drop extensions, which is going beyond oils into other categories in the personal care space. So those are products which are not always of low value. Some of them will be very premium. Our soap is premium. We also plan to launch a few more products in the coming next financial year, which will also be premium, as well as our D2C brands, both Native Soul and 100% Pure are far more premium than almond drops hair oils.
Okay, all right. We'll leave it at that. Thanks a lot for joining in. By the way, we are just heading into 2 new listings, Bikaji Foods and Global Health. The pre-listing rate on Global Health and Bikaji is looking pretty good. Global Health up almost 20%, Bikaji up about 7.5%. Global Health is actually one of the largest in recent times. It's a 2,200 crore IPO, and it's a combination of a fresh issue and an offer for sale. So there'll be a fresh issue of 500 crores. As we know, this is the Dr. Naresh Trehan's promoted chain of hospitals. There's a total of almost 2,500 beds for global health is what I'm talking about. And both those companies listing simultaneously. BKG Foods, well-known brand there. Listing is moderately higher, 322. The issue price was 300 rupees. So that's about 8% higher. Good listing for BKG Foods. For global health, let's just get it up on board. That's the one that's taking it away right now, 20% higher. Fabulous listing for global health, which is Medanta. Remember, the fundamentals are very strong for Medanta. I mean, just in the quarter gone by, it was almost a 30% growth on their revenues. And the valuations are at a discount to its peers, like Apollo, Narayana Health, Max. So there's valuation headroom, and there are good fundamentals, and that is a great combination for a strong listing.
Absolutely. I just wonder, Medanta is such a household name. Once again, in the hospital space, especially in the NCR region. But so, you know, again, that's something which will be closely watched. As Sonia said, I mean, maybe the only name which is cheaper than where global health is coming in at is maybe Fortis, right? I mean, otherwise, there is a valuation gap which is there. 20% higher is a super listing on Medanta or global health, 400 on that one. And BKG, of course, 8% odd gain right at the word go on top of the issue price. I mean, that's again a super listing, I would say, in the market that we find ourselves in. 333 on that one. So the two big listings today is what you have on your screens. Okay, I think Mitesh is back with us for a quick check on things on the market. Mitesh, welcome back. On the Nifty, we don't have very much. This is just a 20-odd point listless sideways day. Pretty much like yesterday, isn't it? And then, of course, we had that last hour surge. Any trades one can take now?
So, Prashant, I think today's price action is not suggesting a trade immediately. If you have from yesterday, just as I said, trade your stop loss to just below 18,300. Or if you get a dip closer to about 18,333, 325 on this spot, then take a 45 point kind of stop loss and then take a long over there. But having said that, MGL is something which is seeing good follow through from yesterday. That's a buy with a stop below levels of 890 for targets of 940. And the other one is on the sell side, that's Colgate Palmolive breaking down on the charts. A sell here with a stop at about 1575 for targets of 1530.
Mitesh, any view on, if you could give us a sense on Balrampur Chini? The stock is up close to 2.5% or thereabouts. From the lows, it's seen a good recovery actually in the last few days. Fundamentally, we heard from the management. Technically, how is it looking?
Management has kind of reversed the trend from oversold levels. So now I think, it went down to as low as about 310 and then now it's started moving up. Immediately, if somebody wants to have a look at the stock, I think your levels of around 344, 343 is the support area. So keep the stock around 342, 341. And I think this up move could see the stock head towards levels of 380 to about 385.
Okay, the stock of the moment is global health. It's almost a 20% rally on that new listing, and it's ticked all the right boxes, right? I mean, there is a strong doctor promoter name, Dr. Naresh Trehan, very good fundamentals coming through, valuations at a discount to peers. In fact, Sonal is tracking this one and is here to tell us more about that. Sonal, big bang listing.
Oh yes, it is at 401 rupees per share, which is at a 20% premium to its issue price. And at the issue price, it was actually trading to a discount 17 to 18 times to its major peers. But now after this would mean that the stock is trading at 22 times, which of course is at a discount to say Max or Apollo, but it's still higher than the likes of Narayana, Fortis and HCG. Be it as it may, the thing is that the fundamentals, as you said, is very strong for the company. And as you mentioned, it is operated or is promoted by cardiac surgeon Dr. Naresh Trehan, operates network of 5 hospitals under brand Medanta, and has a total of 2,467 beds. If we look at why this time around the listing has been strong, first the subscription was really strong, total subscription of 9.58 times for this particular issue. And as far as their fundamentals are concerned, strong Q1 performance, revenues were up 27% at 617 crore rupees, margins Margins in Q1 came in at 21.4%, which compares with FY22 margins of 20.8%, and profits were up 41% as well at 59 crore rupees. Going forward, the management commentary in our previous interviews have been positive as well. So all in all, good listing, and the stock is surging as we speak.
Okay, thanks a lot for that. That's really the stock of the moment, in good health. I just had to say that one.
Yes. Absolutely. I mean, super listing. Well, let's take a very quick commercial break here. My colleague Lata will get chatting with Jonathan Garner of Morgan Stanley from the sidelines of the Morgan Stanley 21st Annual Asia Pacific Summit. That's a big voice you might want to hear in on with regards to markets trajectory from here. They turned positive on emerging markets recently. Stay tuned.
The year 2023 is expected by Morgan Stanley to be very positive for emerging markets because there would be lower inflation, a finish to the US Fed rate hikes, an easing US dollar, and an improvement in global economic growth, more particularly in Asian economic growth. This is the key view that is emerging from the 21st Asia Pacific Investors Conference that Morgan Stanley is currently holding. Joining us from the sidelines of that conference is Jonathan Garner, Chief Asia and Emerging Market Equity Strategist at Morgan Stanley. Jonathan, thank you very much indeed for joining us, and also for what is a generally benign view on emerging markets and Asian emerging markets. Well, first up, why are you so positive? Is it all hinging only on the expectation that US rate hikes will end in the first quarter and probably rate cuts in the last quarter of 23?
Yes, that's an important part of our view, but it's probably less important than the idea that the US dollar has just made a major peak. In fact, over the last 2 weeks, the US dollar has had one of its biggest declines in recent history, down about 8% trade weighted. And that tends to help on a translation effect the earnings streams from emerging markets. We're also emphasizing a lot that a new upcycle in semiconductors and technology hardware is poised to begin. And that's why we upgraded Korea and Taiwan within Asia and EM at the start of October. And I'm pleased to say both those markets are already performing very strongly in the last few weeks, which is highly indicative that the overall EM asset class has reached a trough.
Okay, yeah, Jonathan, I was coming to that. Your overweights include Korea, Taiwan, Saudi Arabia, and Brazil. Equal weight for China. India is not in either list. It's actually an underweight. So before I come to those reasons, do you expect that funds could flow out of India into China? Do you expect funds to flow out of India at all?
So actually, if you look at foreign investor flows, they've been negative in relation to India for some time, and India is by far the most expensive market in our coverage. In fact, at a record high valuation premium, for example, to Korea. So we do have an underweight recommendation on India. It's not that we expect the market to actually fall. We're broadly constructive, but it's not going to have the kind of explosive returns off the trough that we're already getting for Korea and Taiwan.
Just to scratch the point for the, further about Asian recovery, I'm not opposing the view, but I'm just throwing some devil's advocate kind of arguments. You know, at the moment, at least India is seeing a lot of pain on the export front. We just got the October trade figures, and for the first time in many decades, or probably many years at least, our export growth has contracted. It is less than last year, it is less than last month, it is the lowest in 20 months actually. Now, we are hardly an export-dependent economy. Should it not be hurting the other Asian EMs more?
Well, it already has done. So if you look at Korea and Taiwan exports year on year and what's going on in the pricing of semiconductors, in particular memory, we're in the middle of a major bust. But that's when stock price troughs form. And the market is starting now to look out a full year from now to what the environment will be like in the back end of 2023 and early 2024. So there's no doubt that we've been in a very difficult environment, particularly since the summer, in the whole traded goods sector globally. It's a recessionary environment, and that's why these markets performed so poorly, massively underperforming the Indian market until about 3 or 4 weeks ago. When they trough, they tend to trough in a very pronounced V shape off the bottom, and that's exactly what we're seeing for some of the leading stocks which we've upgraded, like Samsung Electronics, TSMC, LG Display, and others.
So your thesis is that 22 is a bad year, but we are at an inflection point, and 23 is going to be a very good year for Asian EMs, right?
Well, we can be quite specific. We think the trough was last month in October, and this is a rally that is developing steam right now. If we're right, then the peak to trough decline in the EM index was 42% in dollars. So that's worse than average for an EM bear market, and it lasted over 600 days.
Oh, yes.
So I know for an Indian audience, it doesn't feel like a bear market because you haven't really been in one. But for the broad EM space, this was one of the worst bear markets ever seen.
Yeah, exactly. That's the table in page 3. That was very interesting. That kind of a fall is not something we saw in India. But Jonathan, you know, in India itself, earnings growth for FY22, that is the year that ended on March 31st, was as high as 39% Nifty EPS. This year, it's barely going to be 10% Nifty EPS. Would you say that India's Nifty EPS growth could be better next year?
So again, there's a rhythm here, because that earnings growth that India's been able to enjoy is not what you've seen for China, Korea or Taiwan, the markets that we're getting more constructive on. And so yes, you know, as long as interest rates and the oil price are relatively well behaved, Indian earnings growth can, you know, not grow as rapidly as they have done historically, but still grow. But you're paying up a lot for that. You're of the order of 50, in some cases 70% valuation premium to the North Asian markets that are now troughing. There are other markets that have a similar characteristic. Indonesia and Singapore have also outperformed during the bear market, and there are other markets that we're turning less constructive on as we're freeing up space to buy these classic early cycle cyclicals.
Well, this is more a Chetan Ahya question, but nevertheless, I'm going to put it to you because as an equity strategist, you have to take a view. Currencies, most of the Asian EMs have been under pressure. Do you expect that to continue for a bit more before they actually bottom out? I mean, there was a worry that the rupee, which had gone up to 83, could go even up to 84 or 85. Does that fear still remain?
So our fixed income and FX strategists also think that there's been a major trough in emerging market currencies across the board, associated with the major peak in the US dollar, which peaked at a 40-year high. And as long as US inflation continues to roll over and terminal Fed funds pricing remains where it is and then goes lower next year, then this will turn out to have been one of the best opportunities, certainly that I've seen in the 30 years I've done this job, for buying both emerging markets currencies, local government bonds, dollar sovereign credit and equities. It really is a very significant opportunity for people to upweight in Asia and emerging markets, broadly speaking.
Okay. Let me quote from your own report, and you may perhaps know this like the back of your hand, the important statement on India: we are tactically underweight Indian equities on relative valuations and technicals and expected to lag any rebound from an EM trough, but we look for entry points into a compelling structural outlook. So when would you time that entry?
Yes. Well, it depends how much underperformance we get versus the markets we've upgraded, and there's quite a lot of that already, so we're watching carefully. But the latter part of that quote that you kindly read out was referring to my colleague Ridham Desai's India Blue Paper about the medium to long run opportunities in India, which are very considerable, particularly in attracting inward FDI, and the very positive long run demographic effect on the market of having such a young population. So hence the mutual fund boom and all of those positive features. So that's what we were trying to say, is that because this is to some extent a target-rich environment and we can upgrade Korea and Taiwan with high conviction here, we are underweight India tactically, but we're not ignoring the strategic bull case long term.
Even as you say that, you say that you are still very positive on Indian financials, so you continue to buy that sector.
Yes, so we do have some recommended exposure there, and again that links a little bit back to the point I just made about currency, but also again just in terms of household formation, underlying earnings growth dynamics for a young population. Indian financials are clearly differently positioned than, for example, Korea or Taiwan or China financials. We're not focused on financials in those markets where you don't have such positive tailwinds.
You mentioned somewhere in your notes that your Asia technology team is extremely bullish. So would that include being bullish on Indian tech stocks as well? They've not been the best performers this year, obviously. but you think that that would come into your buy list?
Well, what we really talked about in Asia ex-Japan is the leading semiconductor and technology hardware names, some of which I mentioned earlier, and they're just simply not present in the Indian market. What you have is IT service contracting outsourcing names, which certainly we're broadly constructive on, but you don't have the giant semiconductor names that you can buy in Korea and Taiwan.
Okay. Let me look at the other point that everyone who is an India watcher is referring to, the domestic Indian equity support. Even in the months from June, July, August, or even before, when there was a large drove of FPI money moving out of India, there was extraordinary support from domestic savings and investors. Do you see that continuing, and would that give the FPI a feeling that they are missing the opportunity of getting into India? Is that likely to keep India well bid?
Well, yes, that domestic bid for India is something we talked about in a number of reports from Ridham and the team over the years, and it's why the market has held up well and is now extremely expensive versus other markets. I'm not seeing any great interest in buying back India yet from our foreign institutional clients. It's really directed more to the markets that I've mentioned, throughout our interview. And certainly one does have to be careful, because kind of retail investor booms globally have ended badly in almost every other geography, obviously notably in the United States around the growth and meme stock investing. I'm not suggesting that that's as extreme a situation in India, but certainly the valuations are very rich to history and to peers, and that's why it is an underweight for us.
Okay. Something related to equities, but it's more a commodities question. How confident are you of a recovery in China? After all, if China really starts consuming, then we should see a boom or a bullish tenor to commodities as well. Are you expecting that in 2023, commodities to get expensive?
Well, we are getting incrementally more bullish about a China reopening trade, having been very sceptical up until recently. But yes, we've seen some important changes since the Party Congress on COVID management approach. And certainly it'll be gradual, we think, particularly around mobility and use of oil, so air travel and driving your car. But it will build up as time goes on, and so we do think the oil price is relatively well underpinned here, and it's unlikely to go much lower.
What are the dangers or the likely things that may falsify your thesis? What can go wrong, the red flags?
Well, the obvious ones are if we're wrong about the peak in inflation in the US and in rates and in the US dollar. Those are the obvious macro elements. And then it's all about how does the tech and semi-cycle heal from here. You mentioned earlier on in the interview the decline in traded goods activity, so the weakness in exports. So we would want that to be improving from, let's say, the summer of next year onwards, that it wouldn't turn into a multi-year bust. But for the time being, things are going pretty well for this call. We're 4 weeks or so into it now, and so far so good for the strong performance from Korea and Taiwan.
Okay. Jonathan Garner, it's always a pleasure having you with us. Thank you very much for enlightening us with your Asia EM approach. That cycle at the inflection point is positive. Thank you, Jonathan, for joining us. Okay, so that's the key takeaway. Well, underweight on India only because of the valuations and looking for a reason to come back to buy. The thesis basically is that you will see a broad Asian recovery. India may not do as well as the other Asian EMs because it's already done very well. That's their thesis, but a very strong medium-term structural positive and bullishness about Indian equities. A break now, and I spoke to Jonathan about commodities. He was generally bullish. We're going to get more about commodities from Manisha Gupta in just a minute after this break. Well, there's a hue of risk-off when it comes to Asian equities and Asian currencies. But commodities are giving us a bullish tone. And to give us more of that, we have Manisha Gupta with us. Manisha, what are you tracking today?
Lata, thank you for that. Well, I'm looking at metals, and November has been such a great month. We have seen copper prices gain up by 12%, nickel is up 16%, but the best of the performance clearly comes in from the iron ore prices, and we have seen these prices gain up by nearly 20% in the month of November until now. Well, the Chinese moves to ease off the COVID restrictions has been one of the major reasons, and the other has been that even as we've seen all the economic data come in from China on the weaker side, whether it has been about fixed income assets, retail sales, GDP numbers, sectors or the realty investment, which has declined in the fastest pace in 32 months in the month of October. But the positive clearly comes in from the fact that China also has increased financing to real estates by yuan 250 billion, and that has been supportive for across metals as a sentiment at least. This is what the iron ore prices have done in this current year. We saw a high of $159 a ton, a low of 79. Currently, the prices are trading at $97 a ton, and this has been a very strong gain in the last 15 or 20 days. Remember, all-time high for iron ore was in May 2021 at $229 a ton. From those kind of levels, as you can see, this year clearly hasn't performed that much better. But the support for iron ore at the current levels also comes in from the fact that the steel prices have gained as well. That one is trading at a 4-week highs. We have seen the steel prices gain up by 6% as well for the month of November right now. This is the output numbers from China in sense of steel. So while the last month was good, this month, because of the higher base on a month-on-month basis also, has seen a decline by 8.3% is the reason you have seen the gain in steel prices. The other factor has been that as winter approaches, so do the pollution concerns, and we do see limited production for steel, and that is also going to impact the markets. But very positive statements really coming in from the major producers. Rio Tinto, for one, says that the long-term demand in case of steel has been on the stronger side, and is the reason all the three biggies, which is Rio Tinto, BHP and Fortis, say that they are expanding iron ore operations and they expect stronger demand by 2023 and 24 as well. Those next 2 years do look positive.
Okay, always good for positive news. Thank you very much, Manisha, for that. I'm not going to start on a very positive note as I speak about the currency. All Asian currencies are under pressure, but the rupee is about 0.5% lower. We have some very specific reason. It could be the trade deficit numbers that have come in rather weak for the month of October. Exports are the big disappointment. $29.5 billion. That's, about 16% lower than what it was both a year ago and a month ago. It was, over $35.5 billion. So that's a 16% fall. It's a 20-month low. We have never seen a sub-30 number since February of 2021. And there is an across-the-board fall in several commodities. Iron ore, one hopes that after what Manisha said, it would be better in the coming months. But iron ore exports have fallen sharply. Textiles, man-made, cotton, made-ups, ready-made garments, all of them have fallen. Carpets, gems and jewelry, engineering goods, chemicals. And that's a huge, stock market angle to it. Both organic and inorganic chemicals have fallen in the month of October. I'm only referring to exports, coffee and leather as well. Many of them have stock market implications. Now, if it is only a question of price, one would have thought that even imports will fall. But imports have not fallen that much. $56 billion or almost $57 billion compared to 61 the month ago. So imports have fallen, but that looks like largely because of the fall in crude prices. Non-oil imports are still pretty high, and that's giving a trade deficit of, about $27 billion, 26.9, nearly $27 billion, a tad lower than the $30 billion we touched in September. But, if you look at the April-October trade deficit, 7-month trade deficit only for goods is $173 billion. That means $25 billion a month, which means we can end the year with 5 more months at about $300 billion if we go at the same pace. Of course, we are surplus in services exports. But if you count that, last year we did a surplus of $150 billion. Even with a 10% upside, which is what people are expecting, it would be $165 billion. Now, $300 billion of goods deficit minus a surplus of $165 billion in services still gives us a deficit of $125 billion in the current year current account deficit, which is about over 3.5% of the GDP. Why is the rupee not falling more? The big reason is the current account gap is expected to be filled by the capital account surplus. The FPIs have been, buying in 4-digit figures, crore figures, every day of the past month. So the dollar rupee is not reacting very badly. It's only in line with other Asian currencies for the simple reason that capital flows are expected to be very good. Now, before I wind up, just a word on the flashes at the bottom of your screen. Metropolis, the diagnostics company, appears to be in the grip of some searches. We are still awaiting more information, but at the moment, we only know that the Income Tax Department is conducting searches. Further details, this is source-based information. We await further details and we will update you on Chartbusters. That's lined up for you in a minute.